I think it's pretty fair to say that it was clear that the Fed was at least a major influence in driving those markets.
If we were up sharply historically in January, up, and all the major indices are up again in February, what is it? What's today? The 20th? It's a short month. I'm glad, because you say if we end February where we are, that historically when the stock market does this in January and February, it has a big year.
It does. So since 1938, there's been 30 years where both January and February have been positive, and 29 of those years,
29 out of 30.
Out of 30 have ended positive and big, on average over 20%. And what we're seeing right now is something that we've never seen before. If February continues to have the performance across the entire U.S. equity market, so that's every segment, size, style, and sector.
We're there right now.
We're there right now. We've never seen 2 months in a row, ever, to have every single segment of the U.S. equity market up. And I think that we could have a good year, but I think it will look a lot different than it looks right now.
We said it was 18% from the lows. So 20%, what do we measure it from? What are we up for? What are you measuring that we're up so far for 2019? How much are we up? Because we got a lot of it in late December. We're probably we're up only 10. So
exactly, we're up almost 11.
So we're talking about another 10% or so.
Exactly.
For the rest of the year.
It could be.
Could be. 29 out of 30 just makes me worry it's going to be 29 out of 31. It just seems like too good, right? I mean, it could be 29 out of 30.
It does. So it does. It seems like it could be really good. But again, I think that what will happen is that we're going to start seeing a split in the sectors, because we've never seen the market move this closely together across all of the sectors and the sizes. So the strength across the board has been driven by the macro picture. But then if you take what's going on with the Chinese trade tensions and you think about, in either case scenario, whether they escalate or ease, that's going to cause a sector split where it depends on the percentage of revenues that are coming from overseas.
The gains that you're talking since the election? 2 years ago, or when you say everybody's moved at the same time? What's the time frame
just
you're talking about?
In December they all went down. Yeah. In January they all went up, and now they're all up again. So even if it's just back to back, January, February, we've never seen that before.
So Mandy, I guess our person asked you, is it time to move any more into cash here? And I just see a big no there.
No, we don't think so. So, I mean, fundamentally, we're constructive on equities. We do think there is further upside, but on a risk-reward basis, if you are cautious, we think it's good tactical level to be buying some protection. So, and I don't mean buying it across the board, but being very selective about where you buy it. So I like looking at sectors that have outperformed significantly year to date. Take industrials; it's the best performing sector, up I think 17% year to date. It's very sensitive to trade, very sensitive to the global growth slowdown story. So could be vulnerable in the coming month. Volatility has subsided significantly. So at this level, I think buying protection via puts or put spreads look attractive to me.
Okay, so you're the chief equity derivatives strategist. So you like your puts. You think that, so would you, out of the money, I mean, how would you do it? Or
yeah, so you can look at maybe 5% out of the money. So you do have a little bit of buffer, but you reduce your premium, and then you're protected from 5% downward, right?
That's
sectors up.
Is that different than raising cash, really? I mean, it is costing you something to buy that.
It is costing you, but you still have the upside exposure, right? Now, if you sell your stocks, move into cash, and the market continues to rally from here, right? You lose out on that. So I do think, from a risk-reward perspective, we think there's still upside to go in the equity market, but with vols as cheap as they are, I think buying some protection makes sense.
So we had some serious volatility.
Yes.
After no volatility for, I don't know whether that was the Fed or what that was. I kind of feel like we have moved beyond what we saw in December in terms of volatility, or is that ready to reemerge? It seems kind of quiet now.
Yeah, for sure. Yeah. I mean, so.
But you say the volatility's back, is it?
Well, I wouldn't say it's back. I mean, I do think the normalization of volatility that we've seen this year is fundamentally driven. It's driven by Fed policy. It's driven by, better than expected earnings. And it's across asset classes. So it's not just equity market where you're seeing that, right? We note, for example, in the bond market, interest rate volatility back to all-time lows, right? Just because, what the Fed's pivot to being patient means they're macro volatility should be lower going forward. So for our year outlook, we see VIX averaging about 15% for the year. It's right now just around that average.
You agree, volatility is back to normal long-term average, what, 15.3%?
Yes. So now it's at 14.2%. So it's actually a little bit below average. It's less than half than it was at the start of the year, and it's the lowest since October. So again, this looks much more normal. I would expect to see the sectors start to diverge and opportunities if the trade tensions ease in the industrials, materials, technology, and healthcare. Those are the sectors that have most impact from the international trade. If the trade tensions escalate, then the real estate, utilities, and financials would be where it would benefit.
So you are watching for a slowdown in the labor market or economic weakness here in the U.S. Do you need both? Because the labor market looks strong, but then we had the retail sales, and I didn't know which one to get behind.
Yeah, it's mixed, and I don't think that the market's forgotten December yet. So there could be some lingering effects from the December drop. So any slowdown in the labor market, any economic
You mean
weakness,
the people who have bought would be quick to run?
I think there is some fear still. Even though we're seeing the volatility come down, which could be an indicator of the market fear, I still think that it's too fresh to ignore. And if there's any impact on the labor market or slowdown in the U.S. or internationally, or weighing where the slowdown is coming, then there's opportunities either in mid caps or large caps, depending on where we're seeing slowdowns in the world.
So, Mandy, the most consensus trade is long emerging markets. So if it's a consensus trade, I don't want to be part of it usually. But you're saying it can be good until it's crowded. So
Yeah,
it's not crowded yet?
No, we watch positioning very closely because, again, like you said, if it's a crowded trade, you don't want to be in it. And on our measures, we don't think it is a crowded trade. So one of the kind of key differences between the rally to start this year versus the rally to start last year, I'm getting questions all the time about the parallels, and of course we know what happened last year, is positioning. So recall last year, market started at a high, investor positioning, whether retail or institutional, were already stretched. And then you had a 6% rally in January. People were chasing as the markets were going up. So in options, they were buying volatility as the market were rallying. Now this year, market started at a low, investor positioning, whether retail or institutional, at multi-year lows, and people really haven't gone back in the market. So, on our prime platform, hedge fund gross exposure barely up since December. And you see it in the hedge fund return data's average return 2 to 4%, significantly trailing the market. So I think, that just tells you there's still a lot of dry powder on the sidelines. I don't think it's a crowded trade yet to be long equities or long emerging market equities.